Have you ever wondered how small investments can grow into a fortune over time? Imagine pushing a tiny snowball down a snowy hill. As it rolls, it grows larger, picking up more snow and gaining momentum. Now let's swap the snow for money. Instead of a snowball, picture your initial investment rolling down the hill of financial opportunity, gathering more dividends as it gains speed. This isn't just a fantasy, it's the power of the dividend snowball effect. In today's video, we're going to uncover how smart choices in your investments can turn even modest sums into a substantial portfolio. What if I told you that by following a few strategic steps, you could potentially earn thousands of dollars each month from your investments? Don't miss out on our upcoming analyses and tips. Make sure you're subscribed and have notifications turned on. Stay ahead in your financial journey. Dividend Snowball Effect. Explained? Let's dive deeper into what we call the Dividend Snowball Effect. This concept is beautifully simple, yet profoundly impactful. Imagine every time a company you've invested in pays out a dividend, you use that money not for a quick treat, but to buy more shares of the same company. Here's what happens next. With each dividend payment, your number of shares increases. When the next dividend payout rolls around, you receive more than last time because you now own more shares. This cycle of reinvesting dividends continuously increases your stake in the company. You might wonder, how significant can this growth be? Think of it this way. Each reinvestment is like rolling your growing snowball across a patch of fresh, sticky snow. It picks up speed and size much faster than you'd expect. To put this in perspective, let's consider a quote from one of the greatest investors of all time, Warren Buffett. Someone is sitting in the shade today because someone planted a tree a long time ago. What Buffett means here is that the benefits of investments are not always immediate, but are immensely rewarding over time. Applying this to our dividend snowball, it's clear that with patience and persistence, what starts as a small manageable investment can grow into a significant source of income. This isn't just a theoretical concept. It's a proven strategy that savvy investors have been using to build wealth for decades. So, if you're ready to see your investments grow exponentially, keep watching. We'll soon explore two powerful strategies to maximize this effect, ensuring your financial tree not only grows, but thrives. Investment strategies. Now that we understand the dividend snowball effect, let's look at two effective strategies to leverage this powerful concept. Whether you're starting with a small amount or ready to make a significant investment, these strategies can be tailored to fit your financial goals. Strategy 1. The one-time investment. Consider this. You start with a single, one-time investment. It could be as little as $1,000. This is your snowball at the top of the hill, ready to roll. By choosing companies that consistently increase their dividends, your initial investment could significantly grow over the years through reinvestment of those dividends. For example, if you invested $1,000 in a company like ABB, which has a strong history of dividend growth, here's what could happen. Over 25 years, with dividends reinvested, your initial stake could multiply many times over, thanks to the compound growth of reinvesting dividends at higher rates each time. Strategy 2. Regular monthly investments. Alternatively, you might choose a more gradual approach. This involves investing a fixed amount, say $200, every month. This method, known as dollar-cost averaging, reduces the risk of investing a large amount at an inopportune time and allows you to build your investment steadily. Using the same company ABB as an example, investing $200 monthly and reinvesting all dividends could result in a substantial portfolio over 25 years. This strategy not only takes advantage of the dividend snowball effect, but also smooths out the purchase price of shares over time, potentially increasing your gains. To illustrate, if John invests $200 monthly in ABB, he could expect his investments to grow exponentially. By the end of 25 years, his total contribution would be $60,000, but thanks to the power of compounded dividends, the actual value of his investment could be several times higher. Both strategies have their merits, and the choice depends on your financial situation and risk tolerance. One-time investments can be a powerful way to jumpstart your portfolio if you have the capital available, while regular investments provide a disciplined approach to building wealth over time. Up next, we'll compare these strategies side by side with real numbers to help you see their potential impact on your financial future. Stay tuned to find out how you can tailor these approaches to meet your personal financial goals. Comparison of results. Having introduced our two main strategies for dividend investing, let's now compare their outcomes. By seeing them side by side, we can better understand the potential long-term effects of each approach on your investment portfolio. One-time investment. Over 25 years. Let's first revisit the one-time investment strategy with our example company, ABB. Imagine that John decides to invest $1,000 in ABB stock at the beginning. Fast forward 25 years, with all dividends reinvested, this initial investment could grow exponentially. Based on historical data and assuming a consistent dividend growth rate, John's initial $1,000 could swell to approximately $29,715. This illustrates the power of compounding. John's portfolio grows not just from the dividends themselves, but also from the additional shares those dividends buy over time. Regular monthly investments. Over 25 years. Now let's examine the strategy of investing $200 monthly. Over 25 years, John will have invested a total of $60,000. However, thanks to the dividend snowball effect and the power of regular reinvestment, the value of his investment could be much more substantial. Using the same growth rates, John's $60,000 investment could potentially grow to over $535,610. This tremendous increase showcases the advantage of consistent investing and reinvesting, allowing John to benefit from both dividend growth and market appreciation. In the next segment, we'll delve into specific types of investments that are best suited for these strategies, ensuring you have the knowledge to start building a portfolio that aligns with your financial goals. Types of investments. Understanding which types of investments to include in your portfolio can significantly impact your dividend compounding strategy. Let's break down three key categories that are well suited for both our investment strategies: dividend aristocrats, high dividend ETFs, and dividend-paying REITs. Dividend aristocrats. First, let's talk about dividend aristocrats. These are companies that have not only paid but also increased their dividends for at least 25 consecutive years. They represent stability and a commitment to returning value to shareholders. Investing in dividend aristocrats is like choosing the sturdiest snowballs for your investment journey down the hill. Examples include industry giants like Coca-Cola, Procter & Gamble, and Johnson & Johnson. Their consistent dividend increases are a testament to their solid business models and enduring market presence. By including dividend aristocrats in your portfolio, you ensure a foundation of reliable and growing dividends, which are crucial for the snowball effect to take place effectively. High dividend ETFs. Next, consider high dividend ETFs. These funds aggregate stocks that pay high dividends, which can diversify your risk across multiple dividend-paying companies. It's like having a variety of snowballs rolling down different parts of the hill simultaneously. For example, ETFs like the Vanguard High Dividend Yield ETF and the Schwab US Dividend Equity ETF offer exposure to a broad array of sectors with a focus on high dividend returns. These ETFs not only provide diversification, but also the ease of managing a single investment while still benefiting from the dividend reinvestment strategy. Dividend-paying REITs. Lastly, dividend-paying REITs. REITs, or real estate investment trusts, are required by law to distribute at least 90% of their taxable income to shareholders. This requirement makes them excellent sources of high dividends. REITs like Kimco Realty and Brookfield Property REIT allow you to invest in real estate without the need to buy physical property. They offer a unique way to diversify your portfolio beyond traditional stocks and bonds, contributing to both income and growth through real estate earnings. Including REITs in your strategy can enhance your dividend income and provide stability in economic downturns, as real estate is often less volatile than the stock market. As you consider these types of investments, remember that diversification is key. Combining dividend aristocrats, high dividend ETFs, and REITs can provide a balanced, resilient portfolio that grows and withstands market fluctuations over time. In our next segment, we'll demonstrate how you can build an ideal portfolio using these types of investments and project the returns you might expect from employing the strategies we've discussed. Ideal portfolio examples. Let's put our investment knowledge into practice by exploring how to craft an ideal portfolio that leverages the dividend snowball effect, using the types of investments we've just discussed. We'll look at 3 examples that combine dividend aristocrats, high dividend ETFs, and dividend-paying REITs to optimize your returns. Balanced portfolio for a moderate investor. For someone looking to start with a moderate level of risk, a balanced portfolio might consist of a mix of dividend aristocrats like Johnson & Johnson and Procter & Gamble, a high dividend ETF like the Vanguard High Dividend Yield ETF, and a stable REIT such as Kimco Realty. This blend allows you to benefit from the solid, consistent dividend increases of the aristocrats, the diversified exposure of the ETFs, and the real estate market through the REITs. Let's say you allocate 40% to aristocrats, 30% to ETFs, and 30% to REITs. Aggressive growth portfolio. For those looking for more aggressive growth, you might increase your exposure to high dividend ETFs and select REITs with higher yield potentials, such as Brookfield Property REIT. Here, an aggressive portfolio could shift to 30% dividend aristocrats, 40% high dividend ETFs, and 30% high-yield REITs. This setup aims to maximize the dividend returns while still maintaining a level of risk management through diversification. The higher allocation to ETFs and high-yield REITs could potentially increase the overall yield of your portfolio, accelerating the dividend compounding effect. Conservative long-term growth portfolio. For long-term conservative investors, focusing on stability and steady growth might be preferable. Such a portfolio could emphasize dividend aristocrats like McDonald's and Coca-Cola, which have shown resilience and consistent dividend growth over decades. In this scenario, you might consider a distribution of 50% dividend aristocrats, 25% high dividend ETFs, and 25% REITs focused on essential real estate like healthcare facilities and supermarkets. This portfolio aims for steady, reliable growth with lower volatility. Expected returns illustration. To illustrate, let's model the expected returns from these portfolios over 25 years. Assuming an average dividend yield of 4% across the portfolios, compounded annually. Here are the projected growth figures based on a starting investment of $10,000 and additional monthly contributions of $200. The balanced portfolio could potentially grow to around $300,000. The aggressive portfolio might reach $350,000, and the conservative portfolio could see growth up to $275,000. These figures demonstrate not only the power of compounding dividends but also the impact of strategic asset allocation. Each portfolio strategy offers different benefits and suits different risk tolerances and time horizons. By understanding your personal financial goals and risk preferences, you can select a strategy that best fits your needs, setting you on a path to building substantial wealth over time. As we wrap up our exploration of dividend investing and the snowball effect it can create, remember that the journey to building wealth is both personal and progressive. Whether you choose to invest a lump sum or contribute regularly, the key is consistency and patience. Today we've covered everything from understanding the dividend snowball effect, to choosing the right investment strategies, to actually constructing portfolios that can sustain and grow your wealth over time. Each strategy we discussed offers a unique approach to capitalizing on the power of dividends. Don't wait for the perfect time to start investing. Begin with what you have, no matter how small. The sooner you start, the more you can benefit from the compounding returns that dividend investing offers. Don't miss out on our upcoming analyses and tips. Make sure you're subscribed and have notifications turned on. Stay ahead in your financial journey.